Welcome to P2 Corporate Reporting. My name is Martin Jones and this is Corporate Reporting ACCA Paper P2. Now where I'm going to start my first recording, logically enough, is right at the beginning with basic groups. The question that I have that I'm going to use to illustrate the ideas for basic groups is a question called Peddle, and it has a parent, a subsidiary and also an associate. So it's parent, subsidiary and associate, and the idea is that it just reminds you of how basic group accounting works. The P2 examination has a lot of group accounting within its syllabus, and some of the group accounting is really quite complex, but that complex group accounting sits on top of the basic group accounting, and therefore it's necessary for you to have sound foundations on which to build your advanced corporate reporting. So that's the reason that I'm going to start with a nice, well, we won't exactly say easy question, but certainly a basic question. As I say, it's called Peddle, and you'll find it in your notes on, it's around about page 18, if I remember correctly. It is indeed on page 18. I have my notes down here just out of camera, and I'm just going to pick up Peddle, and there's my copy of Peddle. Great. So let's have a look at the question Peddle together, and then let's answer it using the scratch pad that I have in front of me. Okay, so the following are the summarised accounts of Peddle, Saddle and Handlebar, which is PSA, as you can see, parent, subsidiary and associate, of course. If you have a look at the income statement, the profit and loss report, it's not terribly exciting. You might notice that at the bottom of the P&L report, there's a movement in the profit retained, in the retained earnings at the bottom of the income statement. Otherwise, it's just a normal income statement. The balance sheet, the statement of financial position, is likewise compressed as well. You can see that it's got very little information on it, and it's just a question really just to remind ourselves of the process of basic group accounting. But there is something of significance on the balance sheet that I wish to point you towards straight away, and that is the ownership percentages of 80% and 30%. When you have a look at the investment in S, it is described as being 80%, and when you look at the investment in A, it is described as being 30%. Now, group accounting is based upon a concept known as control. It is through control that we control another subsidiary. So the relationship between parent and subsidiary is that of control. But how do we get control over the subsidiary directors? Well, the answer is fear. We use the fear of them being sacked. Now, across the world, not just here in the UK, but also in the US and France and in Japan, and right across the world, it's an ordinary majority resolution of shareholders that gives one the power to be able to remove directors, to fire directors, to sack directors. Only an ordinary resolution, only a majority resolution is sufficient. So even 51% would give you sufficient power to be able to fire the subsidiary directors. We, as you can see, have 80%, and therefore, plenty enough to fire those directors. So when we in P say jump to those guys down in S, when we say jump, they will say how high. We have control, and therefore the parent and the subsidiary form one single entity effectively under the control of the main board in P. So that's the group P and S. Now A, do we have control of A? No, obviously. we don't have sufficient voting power on our own in order to sack the directors down in A. We only have 30% of the vote. But then again, 30% of the votes is a huge block of voting power. And to be quite honest, if we did want to sack the directors down in A, we would only have to find another 21% of the other shareholders in order to do so, because 21% of them plus 30% of us would give 51%. That would be plenty enough to sack the directors, and therefore they would go. So we have a relationship with A known as influence, and we're going to communicate the influence that we have over A by using associate accounting. As you will find out, associate accounting involves just two lines. One on the income statement and one on the balance sheet. One on the balance sheet and one on the income statement for the associate. So the associate pretty much gets ignored, quite frankly. Superimposed on top of the basic group accounting. The basic group accounting is between the parent and the sub. And when it comes to the parent and the sub, we do what's called line-by-line consolidation, which means just adding across, adding across, adding across, adding across. So when we come to communicate revenue at the top of the income statement, we will identify that the revenue of 500,000 in P, we have absolute control of that. 400,000 in S, we have absolute control over that. And A, we don't have control over that. So as we work our way, down the income statement, we'll just be adding across, going all, none. All, none. All, none. All, none. All the way down the income statement. Then once that's done, we then slap the associate on top of that with just one line for the associate. Just one line for the associate on the income statement, and then one line for the associate on the balance sheet. So the process is exactly the same on the balance sheet as well. So when we're looking at the net assets, there is in fact just one line for net assets. When we're looking at the net assets of 390 in P and 360 in S and 470 in A, we're going to communicate control. How much of the 390,000 in P do we control? All of it. How much of the 360 in S do we control? All of it. And how much of the 470 in A do we control? None of it. Now, control is an on-off switch. You either have it or you don't. It's different to ownership. Okay? Now, I know the ownership is 100%, 80%, 30%, but we're not going to communicate ownership. We're going to communicate control. All, none. All the way down. Okay. What else does it tell us about the relationships within the group? Well, looking just below the balance sheet, the shares in Saddle and the shares in Handlebar were acquired on the first day of the year. Goodwill has an infinite life and has suffered no impairment. It is the group's policy to value the non-controlling interest at fair value. The fair value of the non-controlling interest is 60,000. Okay, so that's the fair value of the non-controlling interest at acquisition is 60,000. Great, okay. Well, the question, as you can see, says prepare a consolidated income statement and consolidated statement of financial position, otherwise known as the balance sheet. And the traditional method for generating these two primary statements is, first of all, to calculate goodwill and then take it from there. So I'm going to use that traditional method. The traditional method of calculating goodwill is to break the goodwill calculation into two subcomponents, the net assets and then the goodwill calculation itself. And I'm going to do that as well. Okay, so let's start now with our answer to this question, Peddle. So our first answer, our first question, Peddle. Here we go. Question, Peddle. There we go. So it's question Peddle from the first chapter on basic groups. Off we go, starting with the net assets. Now we need to know how big the net assets were at acquisition, ACQ. We need to find out how big the net assets were at acquisition, and we need to know how big they are at the year end, YE. We need to know that both for the sub and for the associate. So we end up with 4 columns. We've got the subsidiary at acquisition and then year end, and then the associate at acquisition and year end, as you can see. Now, the usual way of working out the net assets in an examination is a rather odd method. Instead of working out the net assets directly, we work out the equity at each point in time. And therefore, we start at the bottom of the balance sheet with the share capital. Now, how big is the share capital in the subsidiary now at the current year end? Can you see 50? And next door in the associate, can you see the figure of 30? That's how big the subsidiary share capital is at the current year end, and the same equivalent figure for the associate. Now, there's a rule in group accounting that the share capital never changes. So if the share capital is 50 now, then it was 50 when we made the acquisition 12 months ago. The same, the 30 hasn't changed. But of course the retained earnings change, don't they? Now, going to the year end, going to the balance sheet, you'll see that in the reserves of S at the year end, we have a figure of 310, and next door in the associate, we have a figure of 440. Now, that's the size of the reserves at the year end, but you'll notice that this figure of 310 appears not only on the balance sheet, but at the bottom of the income statement in the reserve movement. Can you see right at the bottom of S's column in the income statement, you've got the figure of 310. Well, immediately above that, you've got a figure of 200. If you look to the left-hand side, they're described as the retained profit brought forward and the retained profit carried forward. Now, of course, this acquisition, as it says in the first sentence, these acquisitions, both of them, took place on the first day of the current year, and therefore the profits that we require in S at acquisition were 200. And the equivalent figure is 300 next door. So because these acquisitions take place at the beginning of the year, we need the profits at the beginning of the year. Now, the share capital plus the retained earnings gives you the equity, and equity is equal to net assets. So we've just identified the size of these two entities at 2 different points in time. Let's add down to get those actual sizes. 250 and 360 and 330 and 470. Now, the main purpose for calculating these net assets is in order to give us this figure here, this 250. That's the most important figure. That's the size of the net assets at the point of acquisition. We're going to compare the consideration at acquisition to those net assets at acquisition to give us the goodwill in just a moment. But there's actually 3 figures that we can get from this schedule. The first one is the goodwill, which comes from the 250. The second one comes from the 360. Now, the 360 is the size of the entity at the year end. Now, we have absolute control of the entire entity, but we only own 80% of it, as you can see from the balance sheet. And therefore, the other 20% belongs to the non-controlling interest. Okay? So we can get the NCI from the 360. And finally, the third figure I was telling you about is the growth. There is a growth up from 250 up to 360 of 110. Now, when subsidiaries grow, I do apologise, when subsidiaries make profits, they grow. When subsidiaries make profits, they grow, and therefore if you can work out how much they grow by, that's how much profits they've made since acquisition. So the growth is also the post-acquisition profits, and the post-acquisition profits helps us to do the group retained earnings. So the three figures that we're going to be using is the net assets of 250 for the acquisition, the 360 net assets for the NCI, and the growth of 110 for the retained earnings. Well, that's getting a bit ahead of ourselves and looking way into the future. So let's get back on planet Earth and just have a look at the 250. Now, the 250 is going to help us to generate the goodwill. Now, goodwill is subject to an IFRS called IFRS 3, which was revised in 2008, and this is the way that it's done according to that schedule. For some of you, this might be new. For others of you, it might be very familiar. Who knows? What we're going to do is we're going to calculate the two of them separately. There's two goodwills, one in the goodwill and one in the associate, and we'll calculate them separately. So goodwill in the sub first, and then separately the goodwill in the associate. The IFRS says we should compare the fair value of the whole business to the fair value of the net assets to give us the goodwill. So it says take the fair value of consideration plus the fair value of the NCI the non-controlling interest, and that gives you the fair value of the entire business. The consideration represents the value of 80% of the business, right? And the NCI represents 20% of the business. And therefore, if we can find out how much our 80 is worth and how much the 20 is worth, then we can find out how much the whole business is worth as a whole. That's the idea that the IFRS has. Now, the fair value of the 80% at the time that we buy the 80% must be what we paid for the 80%. And what did we pay for the 80%? Can you see it on the balance sheet? It's 260,000. Can you see it there? 260,000. So that's 260,000. So I'm going to put that over there and call that sub. Now, I'm just going to put a little strange sort of heading just there. I'm going to put a gap between the percentages and the subsidiary figures measured in thousands of dollars, and put space for a working. Now, you don't always need a working. In fact, quite often you don't need a working. But sometimes you do. For example, just to give you a good example, when you have a foreign subsidiary, you have to play with currencies in order to give you the fair value of consideration. And there are other complexities as well that occasionally require a working. Sometimes when you have a share issue for consideration, you need a working. So just to give ourselves some space in case we need a working, there's one there. We don't actually need it in this example, so I'm being a bit cautious there. But I like to set it up nice and early so you can have that space there if you do need a working. You don't need a working for the fair value of the NCI either. The fair value of the non-controlling interest at acquisition was 60. And therefore, if our bit of the business is worth 260 and their bit of the business is worth 60, then the whole business is worth 320. There you go. Now, we're going to compare that to the fair value of net assets at acquisition. Now, the net assets at acquisition was that 250 I was telling you about earlier. This 250 here. So that 250 there drops itself down here and ends up being compared to the 320. Now, the logic that the IFRS has is quite cute. What it suggests is if the whole business is worth 320 and the net assets are worth 250, then there must be something in the business that's worth more than the net assets. Well, what does the net assets represent? Well, the net assets represents the computers, the tables, the chairs, the buildings, the tangibles, and also the debtors, and also deducting the liabilities. So what is it that is in the business that is excluded from net assets? What is in a business that isn't in net assets? The answer is the people, like me. Now, of course, I'm an employee, and I'm part of the extra on top of net assets. And, of course, I might like to think I'm terribly important, but the really important people in a business is you, the customers. Now, what do we call this fair value of the excess over and above the net assets that represents the people? The answer is we call it goodwill. And how's that come out? 70, doesn't it? Now, I'm going to do something a little bit odd here that I'll be doing very rarely throughout the course, but is available to you. Now, that 70 is partly owned by us and partly owned by them, the NCI. So there's a controlling interest and a non-controlling interest element. And, it comes back to the 70. So the goodwill can be split between who owns which bit. We know that the total goodwill is 70. The total goodwill is 70. But who owns that goodwill? Well, do you remember we're the parent buying 80% of the entity? Well, to be quite frank with you, most of the ownership of the customers comes back to us, doesn't it? We own most of the future expectations of making profit. But if the entity makes some profit, it's obviously going to make us rich, but it's also going to make the NCI rich as well, right? And that's the goodwill. So we just need to find out how the goodwill splits between the two owners. Now, rather annoyingly, because of the way IFRS 3 is written, the ownership is not split between the controlling interest and the non-controlling interest 80-20. It probably should be, but never mind about should, the IFRS says that goodwill often is not split 80-20. In fact, normally it's the controlling interest that has more than their fair share of the ownership of goodwill. Now, rather annoyingly, the only way to break down to find out who owns which bit of goodwill is to do an actual calculation. What we have to do is we have to go back and say to ourselves, right, okay, let's have a look at this. Now, 260 bought us 80%, whereas the fair value of the 20% is 60. Let's work on that, and that's what you have to do in order to work out who owns which bit of the goodwill. So, it's a bit annoying this, to say the least, but here we go. 260 and 60. 260 represents 80% of the ownership, and 60 represents 20% of the ownership. Now, we paid 260 to get 80%, and we ended up with net assets and goodwill. We know what 80% of 250 is. That is 200. So if 80% of 250 is 200 and we paid 260, then 60 of the 70 is our goodwill. Whereas their bit of the business is worth 60. That represents 20% of 250. 20% of 250 is 50. So if their bit of the business is worth 60 and the net assets is worth 50, then their ownership of the goodwill must be 10. It's horrible, that, isn't it? And we'll find a way of abandoning this idea as we work our way through the lectures. Thank goodness we'll get rid of that quite early. But nevertheless, we've identified the goodwill itself of 70 quite easily, and we've found out who owns it with some difficulty. It is owned partly by us, the parent, the controlling interest, and partly by them, the NCI. And the ownership of the 70 splits out 60 belonging to us and 10 belonging to them. Okay, now I would like to calculate for you the associate goodwill. So here we go, the associate goodwill. Now, there's no such thing as non-controlling interest in the associate, and therefore the schedule is much easier. All you do is compare the fair value of consideration for the purchase of the 30% to 30% of the net assets to give you the goodwill. It's much more simple. So it's the fair value of consideration, which, looking on the balance sheet, is a figure of 120. 120, there it is, compared to the fair value of the net assets. Now, of course, the net assets in the entity at acquisition were a figure of 330, and obviously we bought 30% ownership of that. We bought 30% ownership of that. 30% ownership of that, which gives us 99. But not only did we buy ownership of net assets, we also bought ownership of the people as well, and that gives us an excess, a goodwill of 21 in the associate. So that goodwill in the associate plus the goodwill in the subsidiary are going to go onto the balance sheet, onto the statement of financial position. Now, to be quite honest with you, the goodwill in the associate and the goodwill in the subsidiary are kept separate. The phrase goodwill, as in group goodwill, is exclusively the goodwill in the subsidiaries. Plural, of course, if you have a big group, or in our particular case, the subsidiary. So just the 70 will go into the phrase goodwill on the balance sheet. This 21 here, that's going to go into the associate line on the group balance sheet. So let's do the group balance sheet now. So here we go, group balance sheet. Group statement of financial position. SFP, as it's sometimes called. Group statement of financial position with goodwill. Goodwill was 70, wasn't it? And then we have the associate. Now, in the associate, what we have ownership of, obviously, is the goodwill that we've just calculated. That's the 21. But we also have, within this single one line on the balance sheet, ownership of the net assets. Now, the net assets are... Oh, of course, if you take a look on the balance sheet, you've got this figure of 470. Can you see it on the balance sheet, on the actual question itself? So on the balance sheet, you've got the figure of 470. But if you look up here, this is the 470 you should be using. Strictly speaking, you should be using your own 470 rather than the examiner's 470. Strictly speaking, you should be using your own net assets rather than the examiner's net assets. Clearly, if there's any complications in this question, such as a provision for unrealised profit in the associate, then you would pick it up in your own net assets working, and then you should trust your own net assets. So 470. 470, and our ownership of that 470 is 30%. which is what, 50, 150, 141. So 141 is our ownership of net assets in the associate. 21 is our ownership of goodwill in the associate. So that's 162, if my maths serves me correctly. And then we're going to communicate the other net assets, where we have control of the parent and the sub-net assets. Our control reveals a figure of 390 on the balance sheet of the parent and 360 next door, which is 750. Which therefore gives us 2, what's that? That's going to give us, is that 13? 1382. So what's that? 982, if I've done my maths right there? 982. The great thing, of course, about being in a classroom is you guys can check your numbers for me. But there's no one here to check my numbers, so I hope that's right. On to the bottom of the balance sheet with the share capital. The share capital is the share capital of the parent, presented to the parent shareholders, the retained earnings or the reserves or whatever you want to call it. We need a working for that, and we'll do that in a second. Share capital, retained earnings, non-controlling interest, of course, NCI. Which exists purely in the subsidiary. We have absolute control of the subsidiary, a partial ownership, 20% of the size of the subsidiary, which I seem to remember was 360, but I better double check. Yep, there it is there, 360. So 360. We own 80% of that. And the other 20% belongs to the NCI. Now that there is the NCI ownership of net assets. And as you can see, it's a figure of 72, isn't it? But you remember that the NCI also have ownership of the subsidiary goodwill. Do you remember that? They have ownership of the subsidiary goodwill. Where is it now? They've got ownership of the subsidiary goodwill. There's the figure there of 10. So that's the non-controlling interest in the goodwill. It's a figure of 10. So that's going to give us 82 in combination. So net assets ownership 72 plus 10 ownership in goodwill. So the non-controlling interest have ownership of net assets and goodwill to the tune of 82. And then the retained earnings we have to do is a little working, which we'll do right now. So retained earnings is the parent retained earnings. The parent retained earnings from the balance sheet at the year end is a figure of 670. The subsidiary growth from the net assets working, go back to your net assets working. The subsidiary is now sized 360. When we bought it, it was 250. That's 110 in growth. That growth represents profit. And that profit is 80% ours. 88, two fat ladies. And the associate story is very similar. The associate, go back to your net assets. The associate is sized 470, if memory serves me. It's 470 now. How big was it at acquisition? I've forgotten. Let me go and have a look. 470 now. 330. Of course, it was 330, wasn't it? That's right. So 330. Oops. 330. What's that a growth of? 140. 140 is 30% ours. That's a 30% ownership. So that's 14, 28, 42. 42. and we add down, that'll give us the reserves. So that's 0, carry 1, 8, 16, 0, carry 2, gives us 800, I believe. So the retained earnings at the year end were 800. Well, we'll soon find out if I'm right, because we're going to put it into the balance sheet. 800, can I just get that all on? Yep, there we go, 800. So 800 plus 100 gives us 900 plus 82, 982. Does it balance? It does balance. Fantastic. Of course, there's no chance of that happening in the examination, but it's nice when it happens in the classroom. It's nice when it happens in a recording, because it confirms that we're going in the right direction. Now, it probably feels like you've finished the question, but the truth is you haven't, because you haven't done the income statement. So let's do that together now. So I'll see if I've got plenty of space to do my income statement. You'll probably need a full page. Yes, I seem to have plenty of space. So group income statement. Personally, I like to use columns on the group income statement. It seems to work for me. It's not compulsory, but it does seem to help. Parent, sub, associate, adjustment, group. Is that right? Parent, subsidiary, associate, adjustment, group. Yep, that's right. And I'm just going to put a little heading right across the top. Working. So that we know, the markers know, everyone knows that this middle section here, these 4 columns across the middle, they are just a working. Good. Okay, let's get back to our revenue statement. Our income statement. Starting with the revenue, we're going to communicate control. We have absolute control of our own revenue of 500. We have absolute control of the entire subsidiary revenue, because we have control for the entire year. We don't have control of the associate, and there's no need for an adjustment in this question. So that's 900. Operating costs. Are 200, 210 under the control of the parent main board. We don't have control of the associate, and there are no adjustments in this question. 410 to bring us to the operating profit. There's no marks for the operating profit, so we can leave that blank. But immediately below, we slot in the associate. Now, what we do is we identify the profits that we influence, the profit after tax that we influence, which, as you can see from the income statement, is 140. Do you see that on the income statement? 140. Make sure you drop it into the right column, the associate column. There it goes. 140. And our ownership of that is 30%. Giving us 42, which we know already, don't we, from our calculations on the balance sheet. So the associate is 42, and then the associate must come just below the operating profit. And then below that is the interest expense, where we do all or none again. $70 for the group interest expense. PBT, profit before tax. PBT is followed by the tax itself, of course, where we go all or none, yet again. 80, 60 gives us 140. No need to work out these interim profits. No marks for the PBT or for the PAT, the profit after tax. And then following up the profit after tax is the non-controlling interest, the NCI, which is itself followed by the final figure in the income statement called PAM, profit attributable to members. PAM, as it's called, profit attributable to members. And it gives us the rather cute mnemonic, who sits between PAT and PAM? I, NCI. Who sits between PAT and PAM? I, NCI. Okay, so that's where your NCI appears, right at the bottom. And the way it's calculated is you calculate the sub-PAT. To do that, you go right up to the top and add down. So, yeah, you have to add down here. So we have a figure of 400 minus 210 gives us 190, I guess. 170 when we take off the 20. 110 when we take off the 60, if I've done the numbers right. So we have a figure of 110, and we multiply that by 20%. How much of that 110 do we control? All of it. But now we want to find out how much they own, although we have control. We have control, but they own 20%, and therefore they have 22. And of course their ownership is called non-controlling interest. And that's the end of the income statement. It's also the end of our first question, somewhat an introductory question, but what a fabulous question for getting you going in the right direction. So please practice that question until it becomes easy. It is the basis of all of the group accounting at P2, and therefore please make sure you become confident in that question.